Hello, everyone, and thank you for joining us today for the second OIC webinar of April. We're going to talk about standard deviations, normal price distributions, and tail risk today. We're going to dig into some of the basic concepts that are in modern statistics like normal price distributions and standard deviations. We're going to talk briefly about how you can apply some of those theoretical concepts to building a mental framework around the broader market, and then also how you can use them to apply it to specific options theoretics and the specific options market that's in front of you. My hope is that the webinar that we're doing today, along with its sister presentation on Delta that we did last week as a probability measure, is going to give you a deeper understanding of the way that statistics play into options pricing and allow you to see it as a theoretical idea in and of itself, and then also understand when those theoretical ideas are playing out right in front of you with options pricing, and hopefully give you a better way to manage your own risk with options when they align with your investment goals. My name is Mat Cashman. I am the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Just to give you a little quick background on myself, I started trading around 1998. I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Quickly after that, I moved to London and I traded interest rate options there. And then I eventually moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago, again on the floor of the CBOE. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange-traded options. We do that through efforts like the webinar that you're watching today. Now, we always include a disclaimer to make our lawyers happy. Options involve risk. They're not suitable for everyone. Any strategy that I discuss, including examples using actual securities and price data, are strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance is not a guarantee of future results. One tiny other bit of housekeeping: the following trademarks, logos, and service marks displayed are owned wholly by the Options Clearing Corporation. You will see them used throughout the presentation today. Now, a little bit of history on OIC. OIC is the Options Industry Council. It is the educational arm inside our parent company, the Options Clearing Corporation, which is the largest clearing corporation of equity and index exchange traded options in the world. If you are trading options in the United States equity or index market, OCC is touching those options somewhere along the line, either in settlement or in exercise and assignment. OCC is touching that option somewhere between the time that you trade it and the time that it actually settles and or when it expires. OIC started as a collective in 1992 to better educate the public as to the risks and benefits of exchange-traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you can see right here, optionseducation.org. There, you're going to find online courses, podcasts, videos, and webinars like the one you're listening to now. Importantly, we are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Thank you very much, OCC. Now, I work on a fantastic team at the OIC, the Investor Services Desk, or the Investor Education Desk, where I sit with 3 other colleagues, 2 of whom are answering your questions via the chat today during our presentation. Please make sure to say hello to Roma and Mark when you ask questions. Also, please be patient. Oftentimes, lots of questions come in at the same time. They're going to do their best to get you an answer as the webinar is happening. If you don't get an answer to your question today, you can always send us email questions related to options at this email right here, options@theocc.com. This, again, is a free service that we extend to the public as well. It is important to note here that we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do and what we love to do is help with general questions about options, about optionality, and theoretical knowledge surrounding the options ecosystem. Amongst the 4 of us that sit on this investor education desk at the OIC. We have over 100 years of industry experience surrounding options. Always happy to leverage all of that experience to help you in whatever way that we can to help you further advance your understanding of options and how to responsibly use them in your investing when they happen to align with your investment goals. So send us emails at options@theocc.com, and don't forget, optionseducation.org is where all of our educational resources are hosted online. Let's dive right into what we're going to talk about today. I always show annual options volume when I start an options presentation, and the reason why is if you look at how options volume has changed over the last 10 to 20 years, you will see an absolute explosion of cleared volume. And what that means is that there are more people involved in this marketplace, and they are involved in a more frequent basis, trading more contracts. From my seat as an options educator, that means that what we do becomes that much more vital to a healthy, functioning marketplace. As more people become involved in this marketplace, it's important that everyone understand that they're dealing with leveraged investment vehicles, and that leverage can be something that if you don't fully understand it, can get kind of sticky in certain situations. And so you need to understand the underpinnings of these contracts, understand the inherent leverage that is within them, and understand the risks and the benefits of the positions that you're actively putting on when you're trading. So I think that's always an important part of what we do, and it's at the heart of what we do here at OIC. I think it's important to show how much volume has changed over the last 20 years and drive that point home. So now that we've said that, let's get right into what we're going to talk about today. We're going to cover normal price distributions. We'll talk about standard deviations, which is a way to kind of incorporate implied volatility into that discussion and figure out how you can use those implied volatility metrics to calculate standard deviations. So we're going to talk about historical and implied volatility and how volatility affects option prices. At the end, we're going to talk a little bit about tail risk. I'll tell you what tail risk really, how it's defined, and potentially how you might think about hedging tail risk with options, because sometimes people actually use options to hedge tail risk. And then hopefully at the end, we'll have time for some Q&A. Let's dig right in. Normal price distributions. What are they? Normal price distributions look like this, which is what you're seeing over here on the right-hand side. They are also known as Gaussian distributions, or colloquially, we call them bell curves. What they represent is a random distribution of prices in a marketplace. Some of the key features of a normal price distribution are they're symmetrical, meaning you have as many iterations of prices on the left-hand side of the mean as you do on the right-hand side of the mean. So they are symmetrical in their shape. They follow what we refer to as the 68, 95, 99.7 rule. That is something that I'll talk about a little bit later when we talk about standard deviations. This is something that gives you an idea of kind of how much room you can build into the expectation of these price distributions and how far away from the mean you can build that in from a mathematical perspective. These Gaussian distributions or bell curves or normal price distributions are everywhere. They are widely observed in nature, in natural sciences, and in social sciences. One great example is, for instance, if you look at everyone's high school SAT scores across the board, you're going to find that they fall into a very normal price distribution, with most of those SAT scores around the mean. Some of them are going to be very low, and some of them are going to be very high. But the actual iterations of the settlements of those test scores on the high end and the low end are of much lower occurrences than all of these around the mean. That's a normal price distribution, and that's somewhere where you can see it. Some things like that, like test scores, are places where this happens all the time. The way that we use it when we're talking about options is it helps us to understand and build a mental framework around the probability of where these prices might fall within certain ranges. You're never going to have a guarantee as to where things are going to settle. The marketplace is theoretically random. And so you don't have 100% certainty as to where things are going to settle. But what you do have is the ability to zoom way out and think about it from a statistical perspective and apply some of these statistical theoretics to how prices settle. And that gives you a better frame of reference from which you can evaluate risk. And that's our goal here. So, what does a normal price distribution really look like? It basically looks like this with the mean right in the center. If you were looking at something like a normal price distribution of stock prices that were graphed on this axis, and the number of times that that actual settlement price occurred, number of instances on this axis, what you would end up with is a very normal price distribution, generally speaking. This is where the mean is, right? Which is the center of that normal price distribution. And then the farther you get away from the mean, the more standard deviations away you are. So in this case, this would be 1 standard deviation to the downside. This would be 2 standard deviations and 3 standard deviations. And conversely to the upside, 1 standard deviation, 2 standard deviations, and 3 standard deviations. And then beyond, 4 and 5 and 6. That's what this looks like. With that said, let's talk a little bit more specifically about standard deviations. What are they? So, the standard deviation technically is a statistic that measures the dispersion of a data set relative to its mean, and it's calculated as the square root of the variance. Essentially, that's a lot of words to tell you that a standard deviation is a way for you to evaluate how far away from the mean you actually are. How far away is this particular settlement? Is it 2 standard deviations away? Is it 3 standard deviations away? What it does is it reflects the actual volatility of the underlying asset. And this is why, when we're talking about standard deviations, we always incorporated a discussion about implied volatility. Because implied volatility is the actual piece of data that is fed into an options price, and it's going to be where you're actually going to go to actually derive your standard deviations. Higher standard deviations imply greater price variability. I'll explain that in a moment, but the higher your SD is, the higher your standard deviation is, the more price variability and thus the more implied volatility and generally delivered volatility that exists in that environment. Looking at SDs, looking at standard deviations can be really helpful in gauging expected movement in the underlying. And standard deviations are directly correlated to implied volatility levels. One thing I want to bring people's attention to is higher standard deviations imply greater price variability, and standard deviations are directly correlated to implied volatility levels. Both of these statements are essentially pointing at the same core idea, which is when something moves around a lot more, and thus theoretically its implied volatility of the options is a lot more, you're going to have a larger standard deviation, or what I call a flatter normal distribution of prices. We'll talk a little bit more about that in a moment. Normal price distributions, and we're going to overlay these SDs on top of it. So this is where that 68, 95, 99.7 rule comes into play. When we're talking about standard deviations, 68.26% of the time, price iterations will fall within 1 standard deviation of the mean. That's not necessarily a statistical guarantee. It is a kind of like part of the framework of the way people think about statistics. But when you're dealing with something that is shaped like a normal distribution, part of the way that it is shaped is that 68% of the time, basically, all of these price iterations fall within one standard deviation away from the mean. Keep in mind, when we're talking about SDs, when we're talking about standard devs, and 68% of the time within one SD, we don't talk about direction. We don't talk about one SD up or one SD down. We talk about within one standard deviation of the mean. It's not something that's tied to direction. It's not tied to movement up or down in the stock price or the underlying price. It's just tied to actual movement away from the mean. If you take that concept and you blow it out a little bit, you're talking about 2 standard deviations away from the mean. 95.44% of the time, your price iteration of settlement is going to fall within that 2 standard deviations down or up from the mean. This big, giant area under the curve. And then if you think about it even further out from that, 99.72% of the time, you're going to fall within this 3 standard deviations away from the mean, either up or down. This is going to cover you for 99.72% of the time. Now, beyond these 3 standard deviations is when we start to talk about the tails of these distributions. We'll talk about tail risk at the end of this presentation, but I want you to just kind of bookmark that and think about these are the tails. They're called tails for a reason. They're the ends of the distribution, right? They're the smallest parts of the distribution. They are the tails of the distribution. This is the way that people think about tail risk, is that outside of this 99.7% of the time, you've got events that print more than 3 SDs away from your mean. Those are considered tail risk events. Again, we'll talk about that later in the presentation. Let's build in the idea of historical and implied volatilities into this discussion, because this is an important part of this discussion. There's really 2 different types of volatility most broadly when we're talking especially about the options market. The first one is what you see on the screen in front of you, historical or delivered volatility. Historical volatility is exactly that. It is backward looking, and it is basically a record of the price movement of the underlying. It's factual, it's measurable, it's quantifiable. You can put it into an Excel document, you can manipulate it, you can pull out of it the mean and the standard deviation data if you want to, because of the fact that it is very black and white. Historical volatility is backward looking, and it has no forward-looking metric to it. It's merely a measure of how much something has moved. Conversely, implied volatility is the volatility level that is pumped into an options pricing model. It's tied to the market price of an option. I'm going to say that again. It is tied to the market price of an option. Thus, if option prices are moving, and they constantly move, implied volatility levels are likely moving as well. They are inexorably tied to each other. Oftentimes, people ask, well, who sets the implied volatility? And the answer to that question is implied volatility is tied to price. And so if you're in there moving prices around by posting bids or offers that are within the marketplace, you yourself are actually moving implied volatilities around, because the volatility level is actually implied by the price that you are trading or trying to trade. That's why it's called implied volatility. It's a volatility level that is tied to the price, and the price implies that volatility level. Now, implied volatility is the market's forecast, essentially, of the future underlying volatility of that asset. So if you're looking at a 30-day option and it has, at its current price, it's trading, $3, and it has a 20 implied vol, which is tied to that $3 price. What that's telling you is that if that price of the option prints over and over and over again, $3, $3, $3, $3, 20 vol, 20 vol, 20 vol, 20 vol, the marketplace and the crowdsourced ability of the marketplace to forecast implied to forecast volatility of the underlying going forward for the next 30 days, which is the duration of that option, people are constantly kind of, let's call it, agreeing on the fact that that $3 price is the fair price for that option with all of the factors that are currently built into it as an indication of the way that the market views underlying volatility for the next 3 weeks or 30 days. That's part of how this process works. It's a little bit of an interesting process because when people ask about implied volatility versus price, they inevitably want to know, like I said, who's moving it around. And the way that I oftentimes explain it is it's kind of like the chicken or the egg idea. Like, which came first, the chicken or the egg? Well, you know, the chicken came first, but you got to have eggs to have chickens, and you got to have chickens to have eggs. That's kind of how this is. It's a little bit of a circular idea. Price is tied to implied volatility, and implied volatility is tied to price. So if prices are moving, chances are implied volatilities are moving as well. Let's talk about historical or delivered volatility a little bit more deeply. Really, I want you to think about this as a measure of the stock's past movement, range of prices. Previously realized or historical or delivered volatility. This is another thing. Those three words I generally use synonymously. Historical volatility, realized volatility, or delivered volatility. Those are really all the same thing. And what they are is just a historical record of how much something moved. Like I said previously, it's a statistic. It's a fact. It is not a prediction or a forecast. If you want predictions or forecasts, you got to look at implied vols. If you want data and black and white, backward-looking historical prices, you need to look at historical volatility. Now, one thing that is interesting about this is that stocks and indexes and commodities, just underlying prices that have different historical volatilities, also have different shaped distributions. In this slide, I want you to think about this. We're going to compare the distributions of three stocks, each with different realized or historical volatility profiles. Three stocks, one of them is trading a 15 historical vol. Keep in mind, historical vol, we're talking about backward-looking metric. This is a measure of how much this thing has moved. 15 historical vol, a 25 historical vol, and a 35 historical vol. One of them is moving the least, one of them is moving the most, one of them is kind of moving in between. I want you to think about whether or not the actual distribution of prices is going to look differently if something's moving around a lot versus a little. And why? And then we're going to talk about really why that is, because this is kind of the crux of the matter as far as implied volatility and historical volatility is concerned. What I've just put up is essentially the way that the historical volatility numbers affect the actual shape of the distributions. Here's why. A 15 historical vol, or let's call it a relatively low historical vol. This is a stock that's moving around not very much. And because it's not moving around very much, all of the price iterations, the price settlements that happen at the end of every day are going to be relatively close to the mean. Remember, we said it's not moving around very much. So if this mean is 100, the price settlements that happen for this stock are going to be, 99, 101, 98 half, 101, 97 half, 100, right? They're all going to be centered around this mean. Well, what happens when you take a bunch of price iterations and you pack them into an area that is close to the mean? what it creates is the area under the curve that has a very high amplitude, but a very narrow dispersion here. That's why you get a curve that's shaped like this. As you increase the historical volatility, as you increase the actual likelihood that something is going to print really far away from the mean, what happens? You take this distribution, all of these prices that are crammed in here, and you squish it down because those prices are more evenly distributed along all of these potential prices here. One story that I like to tell when I talk about this is in 2008, I was trading S&P 500 options in the pit. And if you were to walk into the pit right before the open and say to me, we're going to settle 100 SPU handles away from where we are right now today, I would look at you and say, okay, that's probably pretty likely because we settled 75 handles away 2 days ago. And we were limit down the day before that, and then we were limit up the day before that. And what I'm saying in that regard is, yes, of course, all of these price iterations that we see on the axis are equally as likely. Sure, are we going to settle up 100 today? Maybe. Are we going to settle down 100? Sure, why not? Maybe. We did last week. But if you were to come up to me and say that to me when we were in a much more placid or much more regular market, I would look at you and say, like, what do you know that I don't know? Because that seems very unlikely to me. Well, that's the difference as far as where the rubber meets the road in these kinds of distributions. When you have relative certainty about where you're going to be, you get a distribution that looks like this. Where does the relative certainty come from? It comes from the fact that every time the market settles, it settles close to the mean. But when you have a situation that does not have relative certainty, what you end up with is a flatter distribution as all of these price iterations become more equally as likely. And that's why price distributions get flatter as implied volatility goes up or delivered volatility goes up, as just historical, as any kind of volatility goes up. And so that's really important to build into this. Let's talk about implied volatility and how it factors into this. Only options have implied volatility. It is the main input for an option price. Remember what I said. Implied volatility and price are inexorably linked to each other. When one is moving, chances are the other one is moving. And it reflects the current forecasted volatility assumption with respect to where everything is right now, looking forward. It's a way to look forward and imply a certain level of movement over the lifetime of the option. Thus, it reflects the marketplace's current forecast for future volatility. It's the consensus of all market participants. Remember what I said. If you're in there making prices, if you're putting prices into a marketplace, you are the person who is changing the implied volatility because you are the person who is changing the price of the option. It's a dynamic input into option prices. It is moving around. Again, I'm going to say this another time. If prices are moving, chances are implied volatilities are moving. Let's focus on the fact that it's a forward-looking metric. If you factor in what we just talked about historical vol and implied volatility, option implied volatility is looking forward. Historical vol is looking backward. Now, this becomes the crux of the difference between option vol, which is the implied side, and underlying delivered vol, which is what has already happened. And essentially what we have is this today part of the graph, which is where the forecast comes to fruition. And how does that happen? It happens through prices changing, through bids and offers. If an option's trading 3 and you think it's undervalued and you pay $3.30 for it, what have you done? You've just changed the price. You've changed the implied vol. You have changed the theoretical market's forecast for how much something is going to move going forward. Now, Will that necessarily affect how much it moves? Who knows? The answer is, I don't know. This is the market's best guess as to how much something is going to move. What do we know for sure? We know two pieces of information for sure. We know the historical volatility of the underlying, what has already happened, and we know that that option that you just paid $330 for is tied to an implied volatility level. This is the part we don't know over here, what's going to happen. And we're never going to know that. You're never going to know that. But this is the actual exchange of risk that's happening in the options market right now. What has happened, where the prices are trading, and what might happen in the future. The interesting part about implied versus historical vol is that they can be at great variance with each other, because one is a forecast of what theoretically is going to happen, and one is an actual black and white record of what has happened in the past. The assessment of future stock volatility is not necessarily right or wrong, right? What is the assessment of future volatility? That's implied vol. No one knows whether or not that's actually going to play out the way that it plays out. But what you can expect is that implied volatility is going to change. It's dynamic. It can happen intraday, over time, abruptly, significantly, and it does not require a change in the stock price. Remember what I said. It is generally a dynamic feature of an options premium, and it is tied to the price. So let's talk a little bit about how implied volatility affects option prices. What I just said is important. Implied volatility doesn't necessarily move when stock prices change, although it is very dynamic and generally it does move around. A change in an underlying's historical volatility may or may not affect the option's current market price and thus the current market implied volatility. But there are a couple things I can guarantee for you. That is, if you keep every factor constant, a change in implied volatility will affect option prices. As implied vol goes up, both calls and puts go up. This is the most important part of this statement. Other pricing factors remaining constant, a change in implied vol will affect option prices in this way. If you keep everything the same and all you do is crank the implied vol, the price is going up. Conversely, if you keep everything the same, other pricing factors remaining constant, a change in implied vol decreasing will bring option prices down. It will decrease both calls and puts. It's important that we talk about the fact that we're discussing a situation which almost never happens, to be honest with you, but this is a theoretical discussion in order to drive the idea home, which is if you keep everything constant and you move implied vol, option prices are going in the direction in which you move the implied vol. So if you move the vol up, the prices are going up. If you move the vol down, the prices are going down. Let's talk about the normal price distributions again and how they look with different vols. What we have here is multiple different curves at different implied vol levels, different historical vol levels, and how the shapes of those curves look. Notice, as the implied vol or as the vol level goes up, this isn't particularly in order, that's strange. As the vol level goes up, these curves get flatter. This is the concept that I was talking about when I told you the story about 2008. As volatility levels get higher, price distributions generally become more flat as all of these potential outcomes converge to an equal likelihood. And what is that equally likely? What is that equal likelihood? It is a coin flip. As you tell me that every single option has the same probability of happening, as far as price settlement is concerned, what I begin to think of is, okay, great, it's a coin flip. Chance of happening. Thus, what happens to option delta in that situation? All of those deltas of options start to move toward the 50 delta bound. That's a really interesting concept for people to kind of think about, because oftentimes delta of options is thought about as this static number. A, it's not static, and B, there are contributing factors to delta that don't necessarily involve movement of the underlying. Now, movement of the underlying can certainly affect delta through things like gamma, but there are other things that can affect delta as well, and implied vol is one of them. Let's look at what delta looks like as a function of implied volatility, because I think that can be instructive here. I want you to think about that environment that I talked about that was a relatively kind of normal and placid environment. And think about what you have as far as the amount of certainty as to where whatever you're trading is going to print the next day. When you're dealing in an environment that has a low volatility number, you have a relative high certainty about where things are going to be. That's the whole point. And so what that means is that options that are in the money are kind of forecasted to stay in the money, and options that are out of the money are forecasted to stay out of the money. And if you take that one step further, what that means is that these options that are out of the money tend toward the 0 delta boundary. And these options that are in the money tend toward the 100 delta boundary. Remember, as you get close to expiration, options can really only have one or the other of those deltas. At the moment of expiration, every option is either 100 delta or 0 delta, unless it prints exactly on a strike. If it pins the strike, technically the calls and the puts have exactly the same delta. They have a 50 delta each. But that happens rarely. But in that situation, what you have is very high certainty as to whether or not this option is going to be in the money at its expiration. If it's in the money now, it's probably going to be in the money at expiration in a low volatility environment. But now I want you to think about what happens to the delta and the likely probability of that option being in the money as you increase the volatility of the underlying. Once things start to move around an awful lot, you have less certainty about whether or not that option is going to be in the money or out of the money. In this case, this option is in the money. This is the 50 call with a $60 stock. The $50 call in a low volatility environment basically has 100 delta. But as you move the vol up, this is on a 40 implied vol, this is on a 60 implied vol, this is an 80, and this is a 100 implied vol. What's happening to the delta? The delta is going down. Why? Because you have less certainty about whether or not this option is going to be in the money at expiration. Why? Because things are moving around a lot more. And that's the crux of this entire matter. Now, conversely, these out of the money options are going to move the opposite direction. This is the $70 call with a $60 stock. When the implied vol is low, this thing has a 0 delta because no one expects it to be in the money. As the vol goes up, as the implied vol goes up, this option starts to tend more toward this 50 delta area, right? With a higher vol, it all of a sudden has a 10 delta, and then a 20 delta, and a 30 delta, and a 40 delta. It's moving toward the 50 delta. Remember what I said. As you move vol to infinity, basically, all of these options start to have a 50 delta. Everything becomes a coin flip. And so that's what you're seeing here. You're seeing this thing become less and less curved and more flat as the vol goes up. Each option starts to tend toward the 50 delta. So if you have a 100 delta option, it's going to move down as implied vol goes up. And if you have a 0 delta option, the delta is going to move up. Now, that's not talking about, I'm not saying that the value of the option is going to go down. I'm saying that the delta of the option is going to go down or up in this case. But this is meant to show you that the delta is dynamic and it is a function of implied volatility. And it is something that you need to keep in the back of your mind when you're thinking about this, especially when you think about it theoretically. Let's talk about tail risk a little bit. What is tail risk? Well, we talked a little bit about this at the beginning. Tail risk is the possibility of large, unexpected moves beyond what is predicted by standard risk measures. It refers to the risk of extreme events, often at the tails, right? These areas of the probability distribution. Colloquially, we talk about tail risk events as more than 3 standard deviations away from the current price. That's not always, but that's kind of where it's centered. And while these events are generally unlikely, oftentimes people hedge them because of the asymmetrical P&L moves that they create. Especially if you have positions that are like short optionality, tail risk events can be very, very, very painful from a P&L perspective. Here are some tail risk events you might recognize. Black Monday in 1987, long-term capital management in 1998, September 11th in 01, the GFC in 07 and 08, the flash crash in 2010, and COVID-19 in 2020. All of these events generated more than 3 standard deviations, in some cases far, far more than that. These moves were massive, and these are what people are talking about when they're talking about tail risk. They're talking about things like this. And thus, when they're talking about hedging tail risk, they're talking about hedging for events like this that are huge, giant standard deviation moves. So what I said about tail risk is that we're talking about it beyond those 3 SD moves. So where do the tails live? They live here. 3 SDs and beyond is generally where people are talking about tail risk. And so what you'll see in some situations is that strangles, which is this put and this call, basically, those out of the money puts and out of the money calls, are sometimes priced by people who are looking to hedge tail risk. That can be where people look for optionality to be able to cushion the blow of some of these moves. So keep that in mind as well. Tail risk strangles can be quoted very often like that, in that way. All right, let's talk about some of these takeaways I want you to really think about. Normal price distribution is essentially an assumption that we make in an attempt to model prices. It's a way that we think about. Now, like I said, it exists in social sciences, it exists in nature. We see it happen everywhere. And overlaying normal price distributions onto a marketplace is a way for us to kind of impart some sort of frame of reference and a way to think about a marketplace that gives us an explanation of how things work from a price perspective. It tries to overlay an ability to forecast prices. Now, these assumptions are inherent in pricing models, including the Black-Scholes model, which is part of what options are priced on. And so you're going to see these kinds of assumptions all over the place when you're talking about financial modeling. It's a real embedded part of how we model things financially. Now, as volatility increases, price distributions become more flat. Remember that very specifically. As things become more volatile, everything tends toward the 50 delta. And the end result of that is infinite volatility creates every possible iteration of price as a coin flip. Everything is equally as likely. And that creates basically, instead of a normal distribution that you're looking at here, you would get a flat line where everything has a 50 delta. Standard devs are really useful when we're measuring broader marketplace volatility, and we want to be able to think about it in smaller terms, or to be able to overlay some sort of frame of reference as to how much something has moved. Oftentimes, when you are talking about movement, it helps to be able to say more generally, how much did that thing move? Well, it was a 3SD move. That gives you a better idea of like how much the thing actually moved. If I told you something moved $75, you don't know what that means. Maybe it's $1,000 index. $75 on a $1,000 index is not a huge move. $75 on a $150 stock is a massive move. In this way, you might be able to telegraph and be able to understand and discuss movement better and more broadly by quantifying it in a more standard way. That's why it's called a standard deviation. Implied vol is the main component of an option price, and it is closely linked to the shape of the price distribution. I've talked a lot about how price distributions get flatter as implied vol goes up, as vol goes up in general. And tail risk is the possibility of these large 3SD moves beyond what is accounted for by standard risk measures. Tails are here, right? When someone says something about a distribution having fat tails, that means that these tails are bigger than they normally are, meaning fat tails imply a flatter distribution, bigger area under the tails of the curve. So that's a lot to take in. It's a lot of stats, but I hope that we presented it in a way that was more broad so that you can understand kind of the basics of how it works and how it really relates to option prices. Hopefully we have a little bit of time left for some Q&A. Mark, are you there?
I am, Matt. Thank you. And a lot of questions that came in. As usual, we our attendees are incredibly engaged with this type of wonderful content. So let's go ahead and start with the question if we can. And here's a question. If up and down one standard deviation are equally likely, why aren't equidistant calls and puts priced equally? I know that it's a concept of option skew, and unfortunately I was responding to these questions, so I'm not sure if you touched on that or not, but please, let us know, in your opinion, why aren't calls and puts priced equally in a typical move?
Yeah, absolutely. That's a really good question. The answer is indeed what Mark said, which is skew. Skew is a measure of the difference between the out-of-the-money puts and the out-of-the-money calls, or what we would call the skewness of a distribution, meaning that in an equity market like the United States equity market, generally speaking, the puts are priced higher than the calls are. The equidistant out-of-the-money puts are priced higher than the equidistant out-of-the-money calls. The reason is that price history of the underlying is kind of built into how the options are priced. And in that situation, what you get is an equity market that theoretically generally crashes to the downside, and stair steps or more placid moves occur to the upside. Well, in that situation, what you're going to get is a series of options to the downside that are theoretically thought to be more valuable because the moves to the downside are theoretically, over a long period of time, are actually skewed to the downside being more volatile events. And if they're more volatile to the downside, those options are going to be priced a little bit higher. What you get when you get a situation like that is puts that are out of the money that cost more than their equidistant call counterparts. That's not always the case in every single asset class. I talk about this all the time when I talk about skew. If you want to look at interesting skew, there's an interesting skew that occurs in agricultural options, things like corn, wheat, soybeans, soy oil, soy meal. Those all have skew to the upside. The calls are priced higher than the puts are. The reason there is that the actual price history of the underlying shows the exact opposite of what we just said, which is the explosive moves happen to the upside and not to the downside with things like corn or wheat. And so the options reflect that historical tendency for the underlying price movement as well.
Okay, excellent. Thank you for that. Now I'm going to combine these next two questions into one. So with this great information that you gave us, the gist of it is, how can investors make use of that information in their daily trading? And the second part, I'll even get more specific. Let's say you're looking at an option chain, and we've got two different strikes, one of which has, say, a 25% IV, and another has a 35% IV. So what are those two different implied vols telling investors when comparing the two strikes, and how can they quantify it and maybe even make use of it?
That's really a great question. There are two ways I think you can look at it. The first one is, if you're looking at the implied volatility level, always remember what we talked about very specifically during this, which is that historical volatility is a backward-looking measure, and it's a measure of how much something has moved in the past. But implied volatility is a forward-looking, forecasted metric. And if an implied vol is associated with a certain price for the option, it's important to think about the fact that not only is that option priced on that implied vol, but what that means is that the implied vol and the price that that option is trading at is an actual forecast for how much that option is going to move over the n number of days that that option covers. And so you can think about the fact that the marketplace, let's say you're trading like right now, we're trading in April, and we're looking at May options or June options. Options that expire in May might be trading on a 25 vol, like you said, and options that are expiring in June might be trading on a 35 or a 45 vol. Well, what does that look like from the perspective of someone who's looking at what the curve, what the actual duration curve looks like from an implied volatility perspective? And what that might mean is that the marketplace currently is expecting a much less volatile environment, but there might be something on the horizon that's happening in June that might not be happening in May that is priced into those options. And that's why those options are priced more expensively, because let's say there might be an earnings announcement, or there's some sort of geopolitical thing that's happening that might come to some sort of fruition sometime in June, right? Elections, things of that nature can oftentimes change how options are priced. So the first thing I would do is use that metric to really look at, this is an indication of what the market is expecting for movement outside, like looking out, looking forward. And then the other thing is that you can actually use what I said earlier, which is the rule of 16, is a way to take that. Anytime you're looking at an implied vol, you're looking at an annualized vol metric, which is the market's best guess as to how much this thing is going to move over the course of what we call an annualized vol. But what does that mean for like the next 30 days? Well, if you want to break that down, you can actually use a formula to take the implied vol, multiply it by the asset price, which gives you the entire block of variance that is expected for the whole year. And then remember what I said about standard deviations. You have to divide it by the square root of time. You have to do that in order to remove the variance out of it and subset it into possibly a smaller piece or a smaller standard deviation that you might be able to look at and say, well, if I divide this number by, let's say, the square root of 252 or 16, it's going to give me an idea of how much this thing should theoretically move over the course of this option's lifetime on a daily basis. That would give you what we would call the daily standard deviation, or you can look at it on a weekly basis or a monthly basis. That's something that you can take that annualized implied volatility number and you can break it down into smaller standard deviation pieces that will allow you to build a framework or an expectation for market movement based on the price and the implied volatility of that option.
Excellent. Thank you for that. And I apologize. While I'm listening to you answer questions, I'm answering them myself. So I'm kind of getting lost a little bit here. But I'm glad that you brought that up, that you kind of transitioned into the rule of 16 and how to, calculate that daily move, because that was going to be my next question. So, thank you for answering that for me already.
Yeah, of course.
Let me ask you this. Here's an interesting one that came in. Why does volatility rise with rising prices in some assets, but fall with rising prices in other assets, and vice versa? You kind of alluded to commodities, for example, and skew, that there's more upside than down and vice versa. But I think I'm interested in knowing your answer or your opinion on this.
Yeah. So ultimately, the reason why that happens is just the big answer is supply and demand. That's the biggest, kind of most zoomed out answer, is that when there's less supply and more demand, option prices are going to go up, and the opposite is true. When there's less demand and more supply, option prices are going to go down. However, when we look at certain asset classes, and like I said before, equity and index options in the United States generally have skew to the put. The reason why is that price history, but then the secondary knock-on effect of that is that the price history then changes how the actual skew is shaped, meaning the puts are priced higher than the calls. And so that actual shape of what we call the skew curve is more steep on the put side than it is on the call side. In that case, you need to think about, and sometimes I wish I had a whiteboard to kind of like draw this out and show you what I'm talking about. But if you think about the put side being steeper than the call side, I also want you to think about the at the money option volatility is going to theoretically follow that skew when the underlying moves to the downside or to the upside. And so if you have something where, like, let's say it's trading $50 and the 20 put, the way out of the money put, is priced on 100 vol, and the at the money put is priced on a 30 vol. What that's telling you is that when you're trading at the money right now, the at the money vol level is going to be a 30. But if you go down to trade 20 in the underlying, which is, 10 standard deviations away, that theoretically, according to this model, the at the money implied volatility level should be 100, because that 20 put is priced at 100 vol. And so when you get a situation like that, that's what we call vol path, meaning the actual at the money vol follows the shape of the skew curve. Now, it doesn't always work out that way. And when you hear people talk about options either outperforming or underperforming, that's what they're talking about. They're actually talking about how the option actually performed when you actually traded down to 20. Was the at the money vol actually 100 when we traded 20, or was it lower than that, or was it higher than that? In a situation where the skew was shaped that way and that 20 put was priced on 100 vol, if the stock actually traded down to 20 and the at the money vol was a 90, you would say that the 20 put underperformed its vol path. But if instead the stock traded down to 20 and the actual vol of the at the money was 150, you would say, wow, those 20 puts really outperformed their vol path. And the reason why is because they traded higher in implied vol terms than the actual skew suggested, or that the vol path suggested. But that's why that happens. And the shape of the curve, whether the calls are higher or the puts higher, is going to dictate whether or not the at the money vol moves up to the downside or down to the upside, or the opposite of that, right? Like in soybeans, where when the soybeans go down, oftentimes the vol goes down. It's because the skew is shaped the opposite direction, and the vol path is what's dictating the actual vol there. Now, I'm going to go back to what I said at the beginning. Ultimately, the big answer to this is supply and demand. And that's what will drive whether or not those options either outperform their vol path or underperform their vol path. If instead of the vol being 100, it actually comes in at 130, that might be the reason. The reason why might be because there's more people buying those options than selling them. And that's the actual supply and demand in action. And oftentimes the nexus of the supply and demand and the vol path is where you get this outperforming versus underperforming idea as far as the options are concerned.
Right. Yeah. Thank you for that. Supply and demand, obviously the end all, the be all when it comes to options pricing. Let's take one more question, if you don't mind. Before we do, we are getting a lot of people asking for copies of the slides. They can download it right there on the console, right below that media player. You can download a copy. Some people were asking us to put up a copy of that key takeaways slide. So when you download the deck, you'll see that towards the end. A couple questions have come in about earnings, and let's go ahead and kind of group some of these together because I think it's incredibly useful from an investor standpoint. When you hear the talking heads on TV, Matt, talking about earnings and the market's pricing at a 15% move, a 10% move, what have you, what does that mean to the individual investor? What should they take away from that comment that, for example, the market is pricing in a 15% move?
Okay, so when someone tells you the market's pricing in a 15% move for earnings, what that really means is that the options are priced in a way that is suggesting that the most likely outcome is that this stock or underlying moves 15% of its value when this event happens, one direction or the other. Always remember, when you're talking about implied volatility in general doesn't denote direction, nor does historical volatility. It just tells you movement, right? It just tells you how much is this thing going to move. So if a stock were priced at $100 and someone told you this stock is pricing in a 15% move on earnings, which is on Friday, what you might look at is that the straddle, the at the money straddle for Friday might be priced for $15 because the stock is $100 and the move theoretically is a 15% move. Now, does that mean it's priced on a 15 vol? No, that does not mean it's priced on a 15 vol. What that means is that whatever vol it's priced on equates to a $15 move in the underlying before Friday or by Friday. And the reason why is because those options theoretically would expire on Friday. But what you can do is you can look at the value of the at the money straddle as an indication for how much the actual supply and demand is pushing implied vols and thus prices of options around in order to actually see how much the marketplace is forecasting for those moves. So it's a really useful tool to be able to look at that. And then a lot of times what people will do is they'll go back and look historically, over the last 10 times that earnings have been announced in this stock. 3 days before, the at the money straddle was priced at X% of the underlying price. And then they can look back and say, was it priced correctly? Was it priced adequately for the amount of move that ended up coming after the earnings were released? There's all kinds of historical delivered volatility versus implied volatility that you can start to compare when you start to back test strategies like that. It's something that people use all the time in that